Very much indeed. Let's bring in Davide Romelli, who's Associate Professor in Economics at Trinity College in Dublin. Thank you very much for being with us. I'm wondering, given the context that Jerome Powell is facing, what would you do if you were in his shoes right now?
Well, I will keep his approach that has been to defend the independence of the Fed. So he arrived to say, despite the many attacks, that the Fed will not bend to any political pressure from U.S. president, and he is aware of the fact that markets, participants, and also households are fully aware of the fact that the firing of the chair of the Federal Reserve Bank will be an unprecedented event in the history of the US and many advanced economies. Indeed, when we think about the firing of central bank governors, we'll typically think about countries like Argentina and Turkey, but we'd never think about advanced economy experiencing a similar situation. So he is aware of the fact of his power, that is the economic power of influencing expectations. And I think he's also aware of the fact that even the economic advisors of President Trump will advise him against firing Jerome Powell, simply because the economic consequences could be much worse than the potential short-term benefit. So thinking in terms of what could happen in terms of economic consequences, we know for sure that already when it happened during the first mandate with President Trump putting pressure on Powell, every tweet was basically associated with an increase in inflation expectations. So in this context of high uncertainty, it will be more likely, I don't want to say a catastrophe, but it will be a cataclysma for financial markets, which could also bring strong depreciation of the US dollar and an increase in the interest rate on US government bonds.
Some people, Davide, would say that's happening already as a whole mess created by Trump's policies. Who is it that's whispering in the president's ear that's telling him to do these kind of things? Because surely this is a strategy. It's not just something he does arbitrarily.
Well, it's difficult. So every president of the United States has typically a council of economic advisors that are typically top economists from top US or European universities, which are leading scholars in their field. But it seems that with this president, the story works in a very different way, that probably he asks some advice to the Council of Economic Advisors, but he then takes the decision on his own. So when we think about the worst damage that can be done by a president to the economy is increase uncertainty. And over the last less than 3 months, we have seen an unprecedented increase in uncertainty, back and forth policies in tariff. And I would not be surprised if tomorrow things calm down with Powell and at the next meeting there will be another firestorm on him.
What you're saying, Davide, sounds incredibly reasonable, and Donald Trump often is not incredibly reasonable. I'm not being political here. I think it's just factual. We can say that. That's the way he is. Do you think in some ways looking to make Jerome Powell the scapegoat for what he's done wrong? For what Trump's done wrong?
Well, I think this is a very good point in the sense that this uncertainty is certainly influencing the ability of the Fed to predict inflation. And for one reason or for the other, Jerome Powell was also criticized in 2022, 2023, when he dubbed inflation as transitory, where we have seen that it reached close to 9% in the US, and we had similar problem in Europe. So already by acting this way, he's already undermining the ability of the Fed to control inflation. Trying to think in a rational way, and we assume that there is a rational thinking, we could say that the policy and this political pressure by President Trump as a double objective. On one side, putting pressure on the Fed to lower the key policy rates, which could potentially lower the value of the US dollar. and reduce the trade deficit the US dollar has. And on the other side, also lowering the interest rates on the T-bills. Is common history and common knowledge right now that the US in the next 2 years will have to refinance a large part of his debt on international financial markets. To me, one of the elements that is not considering is the fact that international investors and even domestic investors, as soon as they will fear that any interference on the independence of the Fed will increase inflation expectations, will have a negative effect on the US government bonds. So rather than having the fact that Trump is expecting of lowering the pressure in terms of interest on the US government bond, he could see the very opposite effects and potentially even trigger a short-term financial crisis on the T-bills.
Davide Romelli, watch this space is the message I'm hearing, and we will. Thank you, sir, for joining us. Davide Romelli, Associate Professor in Economics at Trinity College in Dublin. Thank you, sir.